Let's go now to our friend Beimnet Abebe from Galaxy Trading. As always, Beimnet, welcome back to Galaxy Brains.
Thank you for having me.
2025. We took last week off,
Yep.
and we're back, and it's been already an exciting year. Let's start with what people might be wondering about. Bitcoin went down towards the end of the year a bit, with everything did, right?
Yeah.
Equities sold off a bit too. Then we rallied to like the 102.5 level earlier this week, but now we're back down in the 94s. What's driving the volatility? What was driving this recent dip?
Yeah, I think all roads lead to fixed income in the U.S. primarily. You've had a significant sell-off in the back end of the U.S. Rate curve. You have 30 and 20-year bonds close to that 5% area.
Right, like 4.9 or so?
Yeah, and you've got 10 years at like 470-ish, and it's been a pretty big move over the past 45 days or so, and it comes on the back of strong data. One prime example was yesterday. You had the prices paid component of services ISM print 64.5, well into expansionary territory, and that doesn't bode well for inflation figures that are going to come out later. Services are 70% of the U.S. economy, so you've got reasonably hot price data. You have a Fed that was most recently hawkish and tempered expectations for future rate cuts on a go forward, aka the bar for cutting is significantly higher.
Yeah.
And then you have Trump, constantly talking about tariffs, and I think on the whole, tariffs in the near term will be a positive price shock or inflationary, and so you've got those dynamics. And what I think has happened is, the first, let's say, 50 basis points of the back end sell off, equities didn't react too much because the economy can handle it, right? The rates moving that much higher means that the economy is doing well, less need for rate cuts. But now you're getting to the point in the curve, or the sensitivity curve, where higher rates aren't necessarily good for financial markets. It's kind of like a repeat of kind of 2022 and taper tantrum, et cetera, where as rates move higher, it does put a drag on the economy. And I'll give you an example. There's a ton of corporates that have to roll debt, right? And so the higher long-term rates are and short-end rates are, the more costly it is for those guys, right? And the higher the hurdles for them in terms of returns that they have to meet to justify that type of stuff. And then as as risk sells off, credit spreads also widen. So the outright level to treasuries and the credit spread widening, that's like double whammy there, right? And it's not, and then you throw in higher rates, means stronger dollar, and you've had significant moves in FX markets: euro, pound, CNH, dollar, yen, Brazil. No matter how you want to think about it, everything is getting more expensive in dollar terms, right? And so if you're a company that has a significant portion of your revenues outside of the U.S., which a lot of large tech companies and large U.S. companies do, that's not good. Two, if you're an economy that's a huge importer of commodities, they just went up in price, even though they might be flat in dollar terms, right? And you're having still some positive price shocks in other parts of the world, with inflation coming back in a little bit. And generally, there's just a lot of bad stuff happening. And one of the markets that sticks out to me the most right now is, the gilt market, right? The back end of the UK curve is now higher than when it was during, Liz Truss.
Yeah, that that intervention they did, right?
Yeah, right. And so, there is genuine panic from fixed income investors, right? And ultimately, it is kind of the rate that everybody kind of benchmarks themselves with. Do I engage in this activity because I get paid almost 5% to do
nothing.
Absolutely nothing?
Yeah, with the world's reserve currency.
Yes.
Not even the other markets' currencies, right?
Right. And so you're kind of, and then like housing market, who's going to want to take out mortgages, right? In this type of market, is the housing market going to freeze because home builders can't sell homes and they have inventory of homes that they're building, right? And so there's all these like knock-on effects to higher interest rates, and that's kind of what the market is kind of latching on to right now. And fundamentally, what is an equity? It's a stream of cash flows. And how do you value a stream of cash flows, versus a discount rate? And what is that discount rate? It's based on where rates are expected to average. Those rates are going higher. And so you're at that part of the market cycle, the rate bond sensitivity, where like the higher rates go, the worse it is for risk assets, right? And, I'll tell you that Bitcoin, in my head, is a store of value, and it should be like the debasement hedge, blah, blah, blah. But at the end of the day, I think it still fundamentally is more of a risk asset at this stage in its like life cycle.
Right.
Right. Okay. And I'll give you the prime example, like over the past week, is gold's actually up. Right. Why? Because, folks are worried about debasement because Trump came out and was like, oh, the U.S. economy needs lower rates, right? And at the same time, data's hot and warrants higher rates. And so what did people do? The curve steepened and, gold rallied, right? And people need alternatives from the dollar. And there's central banks that buy that stuff. And so it's got characteristics that are more store of value oriented. But Bitcoin right now is struggling, right? Now, I would tell you that if crypto was just Bitcoin, I would expect it to perform more like gold. But the crypto market is so intertwined with each other in the sense of like you have all of these protocols that are worth billions of dollars. Some of it rightfully so. Some of it, is overvalued, right? And so when you have it like so correlated, right, and people are selling these assets that don't have that real like store of value component to them, like it bleeds into Bitcoin.
Yeah, especially with like bigger money investors, they might love Bitcoin and understand it, but also just sort of think of the crypto market as sort of one big thing. And you still see a pretty high beta between Bitcoin and the other assets in the crypto world. Do you think that if we, let me put it this way. You're talking about how it should be a hedge and it's still a risk asset. I agree with that. I think it's monetizing with the goal of becoming a gold-like asset. But if it wasn't volatile and a risk asset, there wouldn't be how much upside we think there is long term.
No, absolutely.
Right? Because gold, has moved a lot. Had an incredible year.
A phenomenal year.
And what was it up? 40%? I'm making this up. I forgot.
30s,
30, 40? Yeah, so but like that's like a banner year for gold.
With a great sharp.
Right.
Yeah.
So but that's like in Bitcoin terms, like that's, it's an okay year, like 30%. I mean, it's like Bitcoin was up over 35, 40% or something, right, last year. So
no, but I just think that as assets like scale and more people like invest in it, right, the things that drive them are going to be things that drive other things.
We know the fundamental characteristics of no issuer, no insiders, non-sovereign, commodity-like fixed supply asset. That sounds a lot like gold in a lot of ways, right? It's not being used like that at scale. That's not what's marginally driving its price at the moment.
Yes. But I do think that, there's a ton of crypto-specific tailwinds that will come from a Trump administration. But, I have a little bit more of a controversial take on this. I think in terms of Trump's impact on crypto, I genuinely think it's going to be more in the alt arena and stablecoin adoption and stuff that is less Bitcoin oriented. And the only way that I would change that view is if we do actually go through with the strategic Bitcoin reserve in a meaningful way. But absent that, I think the pro-crypto policies that the administration is likely to pursue are actually more beneficial to the rest of the market. And so, I struggle to see how Bitcoin, doesn't just perform with the broader market. And there's a lot of things to suggest that the broader market will do fine because Trump cares about stocks and he wants lower interest rates, and people still have to put money to work. And like U.S. equities are still great, and you're having a fundamental paradigm shift with AI and all of the investment that has to go along with that. Power, transistors, other sorts of infrastructure, and then the ultimate productivity gains. I still think you're in a tremendous kind of point, at a great point in the investment cycle, for this stuff, and you're very early still. And so these structural tailwinds, I think, are still good for broader U.S. equity markets, and that should be good for Bitcoin. But in the first 100 days, like you can already see it now, it's going to be a lot of chop because it's going to be headline driven, tweet driven, Truth Social driven. And, right now folks are very worried about the rate policy path. And so if you do get hot data, like the Fed is not going to be like going to gloss that over.
Yeah, people are jumpy out there, right?
Very jumpy and nervous.
Yeah.
And
it's going to be, like always, data-driven here, right? I mean, if we get more reasons to have fewer cuts or no cuts or hikes, right? What do you think the odds are?
That's going to be my sign to flip on the rate trade is when people start talking about hiking.
We haven't heard it yet.
We haven't heard it yet, but soon enough. You can get it on Friday with non-farm payrolls. It's literally a random number generator, the way they do the data. Was
NFP the one that they had to like update for like 12
all the revisions,
yes. And it was like bad. It was a lot of revisions.
Because the death quit ratio,
it was like significant amount of revisions.
And it's like people trade on a number that like gets revised multiple times.
I mean, there were some revisions that were literally the opposite. Like it came out up a huge, and then they revised it to actually was down huge.
Yeah, but at the end of the day, like that's what the Fed uses, and like they look at that stuff. And I keep reminding people, it's like, inflation's coming down, blah blah blah. I'm like, like core PCE last time I checked, I think was around 2.9. Then you're still 90 bips above target, and like, that's still reason to keep rates elevated. And like if you look at the U.S. economy, it's gangbusters with high rates, so it can clearly handle it. I'll give you one metric. Like, I think holiday spending this year, I was looking at one thing, it was up 9% year on year.
Wow.
9%.
That's a big gain.
Right. You telling me people feel poor right now?
And that's nominal, right? That's not so that's above the inflation rate, right? So it's not like that's.
I mean, that's above nominal growth.
That's what I mean, above nominal growth. Yeah.
Right.
So wow.
And so
people spent a lot.
People spent a lot. Maybe it's consumerism, people spending more money than they have, whatever it may be. But it does tell you that the economy is still in a good place. You look at job openings that were out yesterday. Big beat in job openings. Services PMI.
Companies are hiring. People are spending. So, yeah, it's not slowing down.
Right. And
which
so
all is inflationary is the idea.
And the economy can handle higher rates.
You've been a long time, you've been saying this. You were saying it over the last few years in general. Like, you were cautious on cuts when everything's going great. Like, you always wanted more policy maneuverability for the Fed, right? Like, I would say in general, you've been on the hawkish side of why do you need to cut? You're still not at target. You still need them to come down. Everything's going okay, right? And they only cut a little bit, right?
No, and the cynic in me tells me, and again, this is not the opinion of Galaxy. It's just my opinion.
Yeah.
But I think the Fed was forced to be a little bit more dovish than necessary because they didn't want to be seen as interfering with the election, and I think. If I had to guess on who they wanted in office, like this is just my opinion again, but I genuinely think that they wanted stuff to be okay and trending well going into the election.
Yeah.
Right. And right after the election, they're like, we're cutting, but the bar is really high.
And we're going to be mean about it.
And the data is really good.
Because that hawkish
cut. It was a very big hawkish
Yeah, that
shift.
hawkish cut was what capped Bitcoin at 108. Like that is basically, it was right after that. The next day, Bitcoin started to slide that went all the way down to 91.5.
It was a massive tone shift. And it's like, wait, did everything change in a month?
No, I like your point about the long-term structural tailwinds for both the economy, for crypto, for Bitcoin are positive still. But we're in a chop period, and just let's mark the moment that we're talking about a crash to the $90,000 level
absolutely.
Is still what a
and to just offer a flip side to my argument of higher rates and that side of things, like you have a stronger dollar. The U.S. imports a ton of goods, right? So that should be like
that's counterinflationary, deflationary.
counter-inflationary. The government's also going to deregulate, right, pretty aggressively. The Trump administration.
What about
will.
stable coins picking up those back end of that curve? Although all the
No,
bills,
they don't.
I
It's
know they
all
all want the
front-
front, but
front.
maybe we should.
No, but that spills over into the back end.
And
as
also
well.
maybe that should be a consideration for the U.S. government.
I don't want my stable coins taking duration risk and having mark-to-market.
No, I know, but
losses.
you can do like 50% has to be short, and then also like some of whatever. In any
That's
case,
quasi hedge fixed income hedge fund stable coin. I mean, you want me to
well,
run
in any
it?
case,
I will.
though, buying the debt in any case at whichever duration.
Yeah.
Just for the audience, I think the original details of the stablecoin compromise bill in the House Financial Services Committee, like at this point, like 2 years ago, between Pat McHenry and Maxine Waters, I think was short-dated Treasuries, 90-day duration or less.
Yeah.
Right. Which is, I mean, I know Austin Campbell opposes that. He said you need a little more flexibility than that, but like I don't know exactly. I forget. I don't want to speak for him.
No,
but like in any case, it was all short-dated.
I
to your
think
point.
1 year and in, like I'm comfortable.
Yeah.
Right, because
Highly liquid, like
Yeah.
easy to get out. All right, well, this is an exciting time. We still
Absolutely.
have a lot more. My gosh, it's going to be an exciting several months.
it'll be volatile.
Yeah. Well, that's what
I'm
we like.
excited,
Michael
honestly.
Saylor says volatility is vitality. So,
You know what?
you're
That's
live.
a great note to end on. I love that.
Your heart is beating. You know.
Yeah, I want to live. I want to feel stuff like the ups and the downs.
Our friend, Beimnet Abebe from Galaxy Trading, as always. Thank you so much.
Thank you.